I think we're in terra nova in the United States, and in fact, much of the developed world. We're at a risk of getting into a credit cycle. Hyperinflation is a very real risk in the United States. If you had to pin me down and say, what do I think is the probability of it? I would say
There are four mainly deep risks that face the economy today. We're going to talk about what these are and how investors can protect against these risks with our next guest, William Bernstein, who is a financial theorist, economic historian, and former clinical neurologist before moving into the finance world. Dr. Bernstein was the co-founder for the Efficient Frontier Advisors and has written several books on finance and economic history, including The Four Pillars of Investing, Lessons for Building a Winning Portfolio, and The Birth of Plenty, How the Prosperity of the Modern World Was Created. We're going to be talking about his drivers of economic growth, his outlook for economic growth, and these risks and everything in between. This is a very interesting discussion. I'm very excited to share this with you. This episode is brought to you by iTrust Capital, an IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1%. If you're over 18 and you'd like to open a new account with cash or roll over an existing account, click on itrust.capital/David in the link down below to learn more and get started. And if you fund your account using my referral link, you get $100 in signing bonuses. Dr. Bernstein, it's good to see you. Welcome to the show. Thanks for being here.
good to see you, sir.
Let's start by talking about your work. You've analyzed a lot of the risks that financial markets have faced over the last couple of hundred years and how investors should respond to some of these risks. Let's start by addressing what, in your opinion, is the biggest or some of the biggest risks facing markets and investors today.
I tend to look at risk from a very long-term perspective, so I really don't care that much about volatility. The human concern about volatility is really an artifact of our evolutionary past. And as we all know, if you let short-term volatility get to you, you're going to have your head handed to you. I prefer to look at risk from a very long-term perspective. And if you look at financial history, there are four big ones. First and foremost, more important than any of the other three, is inflation. It's everywhere and always in financial history. There are very few nations that have escaped hyperinflation, let alone serious inflation. And then the next is deflation, which is something that you see during financial panics. It's usually very short-lived. And in the era of vigorous central banks and fiat currency, it's a pretty easy thing to take care of. There's confiscation, which is when your government takes away your assets. We've seen some pretty catastrophic examples of that in the past 150 years, particularly in China and in the Soviet Union. And then last is devastation, which is something you don't want to discount. On several occasions in the past 50 years, we almost blew up the planet. I lived through October of 1962, when there were probably a couple of Soviet subcommanders who saved the world from getting blown up. We came preciously close to that, as well as several other software glitches that almost caused a nuclear exchange. So those are the big four risks that you worry about in finance.
And you mentioned to me offline the fractional reserve banking system has created risks in its own. Can you comment on that?
Well, you have a system where banks literally make money. They create money. And when times are good and people are feeling good, they create a lot of money. And then when people start to worry about the financial system, and they pull in their horns, that leverage disappears. And deleveraging, as we found out in 2008 and 2009, is a very painful process. And so we're subject to a process that was well described by Hyman Minsky, where things start out in a stable system and people decide they're going to leverage up to juice their returns. And then there is a panic. They get religion, they deleverage, and that once again creates stability. So you have a system where stability produces instability and instability produces stability. And you get these cycles, which appear to cycle over a period of around 10 years. That's very, very rough. I mean, there was one part of the cycle from the 1930s that lasted for 30 years. So it's not something that you can set your watch by.
So let's talk about some hedges for these risks before we get on to other themes of your work. So starting with inflation and deflation, well, I guess deflation is pretty straightforward. You just hold cash, and presumably in a deflationary environment, your cash increases purchasing power over time. But what about inflation? Have you done research on assets that have consistently outperformed the CPI on a longer term basis?
Uh, Perhaps not outperform it, but at least not lose your shirt. So the classic one again is short-term, high quality fixed income assets are the primary hedge. Inflation index bonds, particularly now that they're selling relatively cheaply, are not a bad way to do it. Commodities producers also do that. I'm not a big fan of commodities futures because they're subject to contango. You get a negative roll return over the past 10 or 20 years because everybody and their dog is trying to protect against it. So you wind up with the opposite of normal Keynesian backwardation. In other words, contango. So I like the producers, the stocks of the producers, better than I like the futures. And finally, over the very long term, stocks are not a bad hedge against inflation. One of the things that people didn't realize about the Weimar inflation of the early 1920s is that over that long 4 year cycle from 1920 to 1924, when the Reichsmark devalued by a factor of 1 trillion, that's trillion with a T, the real return of stocks was actually positive over that whole period. And then finally, there's a class of stocks that does do very well with inflation, or relatively well with inflation, besides commodities producers, and that's value stocks in general, because their liabilities are denominated in nominal currency. And when that nominal currency deflates, that decreases the amount of their real liabilities, which goes to their bottom line. So if you look at what happened to stocks in the U.S., for example, in the 1970s, value stocks did very, very well for that reason.
Well, let's talk about hyperinflation. You mentioned that very few countries have escaped the grasps of hyperinflation, or at least the risks of hyperinflation. Well, the U.S. has seen severe inflation in the past, but if we take the technical definition of 50% inflation month over month, we haven't seen hyperinflation just yet. Is that a risk that is still worth considering, Dr. Bernstein?
I think so. I think we're in terra nova in the United States, and in fact, much of the developed world. We're at a risk of getting into a credit cycle where the liabilities of the government, the national debt, increases to the point where the servicing costs actually start to raise the cost of that capital, tend to jack up interest rates. And so the more interest rates go up, the higher the servicing costs, and then that does damage to bond prices and yields go up even further. So you wind up in a spiral. The United States has never seen that spiral like that. And so some people take comfort in that. But I think at this point, it's a very real risk. We're in peacetime, and we're still running these enormous deficits. People aren't willing to either cut benefits, government spending, or alternatively to raise taxes. And so both under Republican and Democratic administrations, you've seen a spiraling of the debt. And I think that a debt crisis with hyperinflation is a very real risk in the United States. If you had to pin me down and say, what do I think is the probability of it? I would say 10 or 20%. That's a risk I'd want to hedge against.
Now, that is a multi-year, multi-decade risk that can unfold over a longer period of time. We're not talking about hyperinflation next year, right? Is that just so I understand your framework here?
Probably not. But debt spirals can unfold very quickly. So I would not be willing to say not next month. Maybe a 1% risk of it happening next month, maybe a 20% risk of it happening in the next several years.
And what we've seen over the last couple of years, perhaps last couple of decades, is a lot of deep risks sort of working in tandem. For example, during 2020, we had the pandemic, which I guess you could categorize as a devastation, which also created severe inflation. It wasn't technically hyperinflation in the U.S., but it was severe enough that people were scarred for, quite some time, right? How do these forces work together?
Well, you've just brought up a very, an interesting subject, which is that you really can't foresee risks very well. Who would have predicted COVID? All right. Who would have predicted 9/11, for example? And so there will be financial crises. We may see severe hyperinflation over the next decade or two, but we really haven't the foggiest idea of what's going to trigger it. Chances are it's going to be a big surprise.
I believe you wrote, and correct me if I'm wrong, but I believe you wrote that gold is a good hedge against deflation, but not so much inflation. Is that correct?
No, that's correct, and that simply falls out of the work that's been done by Vinson, Marsh, and Staunton. This was in one of their yearbooks, their Credit Suisse yearbooks, I think about 10 years ago. And what they saw was that gold was at best a so-so hedge against inflation, but it was a spectacularly good hedge against deflation. Well, it wasn't that you're hedging against deflation, you're hedging against the thing that causes deflation, which is a loss of faith in the banking system. And gold does very well under those circumstances.
If you were to guess as to which is more likely in America today, higher inflation or deflation, what would it be?
Well, just when you look at the base rate, inflation is far more common than deflation. Even Japan over the past 30 years hasn't technically experienced deflation. It's had a very, very, very low, almost zero rate of inflation, but they haven't experienced deflation over the past 30 years. So it's a very rare thing.
Has it ever occurred to you that the central bank's targeting of 2% is somewhat arbitrary? Some economists have argued that we don't really need 2%. We can get by with 0%. That could stimulate economic growth. Where do you stand on this?
Well, the curious thing, and I think we both know this, is that where 2% comes from, I believe, is it was a decision that was made by the New Zealand Central Bank decades ago. So why 2%? Why not 3%? Why not 1%? I don't think anyone knows the answer to that. There's a deeper and more troubling problem here, which is that central banks have gotten hooked on both low interest rates, and of late quantitative easing. And so what you do is you have artificially low real interest rates, negative real interest rates for that matter, over a very long period of time, and that lowers the hurdle rate. So you get this boom and bust cycle where people become euphoric when rates fall, and then the bank tightens a little bit, and then people panic, and then the central banks lose their nerve and they loosen again. And there are some who suggest, Ed Chancellor is certainly one of them. There's a fellow at the BIS, I think his name is Claudio Barrio, who's done fairly rigorous research that basically ascribes our low economic growth to this low hurdle rate. Okay, when the price of everything when the price of money goes to zero, then the price of everything else goes haywire.
Confiscation is an interesting risk. So in the U.S., we've studied a few cases of confiscation. It could be argued that Roosevelt confiscated gold way back, but I don't believe there's been major cases of confiscation here in the U.S. Can you address this?
Well, if you're a hardcore libertarian, you say that all taxes are theft.
Okay.
And, and so, all taxes are confiscation. Now, one of the things that I wonder about, because I had a career as a medical professional, is that, like a lot of professionals in the United States, I have a large amount of sheltered assets, which come from rolling over of pension plans. And so I worry a lot that the government is going to come after those hammer and tongs. Well, it turns out that in the early 1960s, there was a tax on excess distribution from IRAs of more than $100,000, which I think would shock a lot of people if that occurred. And I wouldn't be surprised to see happen under a Democratic administration. So that would certainly be confiscation of a sort. Now, don't get me wrong. You can't infer my politics from that. I actually wouldn't be unhappy to see that, but that would be a form of confiscation.
So what you just said, how do we protect against that?
There's almost no way to do it unless you want to start, squirreling your money abroad. If you're a U.S. citizen, it's very problematic. You start moving assets abroad, and you wind up incurring all sorts of both civil and criminal risks. It's not something I would recommend to anyone. There's not much that an American citizen can do it. do about it. I suppose there's one reasonably safe way to do it, and that's to buy gold and put it into a foreign vault. And then you're not creating any income that you have to report to the government. So you avoid legal problems by doing that. You can buy foreign real estate. I wouldn't recommend doing that. It's very complicated. It's very cumbersome. It's very messy. But if you've always wanted to have a flat in Florence or in Paris, then yeah, go knock yourself out. That's a good way to do it.
People have also looked into putting cryptocurrencies in a hard drive that the government can't physically confiscate. This is a relatively new development. Have you looked into that?
It's a theoretical possibility. I'm not a big cryptocurrency enthusiast. I think that there are going to be a lot of people who are who are going to wind up doing that, who will probably wind up sorry they did in another 10 or 20 years. Not necessarily because they're going to lose their hard drives, but of one of two possibilities. Number one is that the price of cryptocurrencies is very unstable. So it's not a good store of value. It doesn't qualify as money simply from that perspective. But the other is there's a security risk. I would not assume that just because it's in a hard drive that you've air gapped from the internet that it is safe. I'm reasonably certain that the U.S. government, or more likely the North Koreans, have figured out a way of hacking into the blockchain.
Devastation is the last risk that we've addressed. By definition, a black swan is something we can't really predict. But per your analysis, what are the biggest risks facing the world right now that could potentially devastate markets?
Oh, I just talked about it 10 minutes ago, which is the risk of nuclear devastation. It's something we seem to have forgotten about. If I had a choice for my children and my grandchildren of taking a 10% risk of nuclear devastation off the table in exchange for living with global warming, I would still rather take that 10% risk of nuclear exchange off the table and suffer the consequences of global warming, which are going to be considerable. So that is by far, absolutely by far, the biggest one is the risk of nuclear exchange. In which case, your portfolio is going to be the least of your worries.
Red Dalio believes there's a 35% chance or even 40% chance that the U.S. sees a civil war. I don't think he means that. Nah, he's written about this, actually. I don't think he means it literally with guns. I think he just means more polarization, people moving to different states that align more with their ideologies and so on and so forth. But 35 to 40% chance is pretty high. He's advocated to hedge against this risk by, like you said, moving assets abroad, investing in emerging markets, so on and so forth. Anyway, have you looked into civil war risks?
Yeah, again, this is one of those things. There's not a lot you can do about aside from owning foreign assets, but you're still going to have the U.S. government looking over your shoulder at those assets that you're holding. Uh, you know, is there a risk of increasing polarization? Sure. What Mr. Dalio is doing is tapping into something called the Big Sort, not the Big Short, but the Big Sort, which was a book that was written by a guy by the name of Bill Bishop 15 or 20 years ago, before the Big Short was written, and it's about how we're sorting ourselves in the United States and in other places into communities that fit our culture and our political beliefs. So I live in Portland, Oregon. I can tell you that not a lot of evangelicals willingly move to Portland, Oregon. On the other hand, not a lot of political liberals are going to move to Lubbock, Texas. And so we are sorting ourselves into separate bubbles. And you can see that very, very vividly in presidential elections by the margins that presidential candidates win. It used to be unusual to see a candidate win a state by more than 20%. Well, now it's the rule in hardcore blue and red states. So we're seeing real electoral polarization, to say nothing of ideological polarization in this country. Is that a risk, a financial risk? Maybe, but it's not up there in my top five.
Well, is rising social unrest, a financial risk? Does it have any direct impacts on financial markets at all?
Not unless it gets to be extreme. I think when you get to the point of physical insurrection and violence, I think it might be a problem. But I'm reasonably certain that the extremist communities on both sides who would perpetrate that violence are pretty well infiltrated infiltrated by law enforcement, particularly the FBI. I don't worry greatly about that, particularly after January 6th. And then there's the other thing, which is extremist groups are also very reticent these days to engage in organized violence for the simple reason that they're paranoid enough that they think that it's all provocation. They're very wary about any violent demonstrations because they wonder if they're being played.
These tail risk devastations that we mentioned, including a 10% chance of a nuclear war, are these things that we should really consider as investors? Presumably, if we have an all-out nuclear war, everything goes down. I don't know if there's anything we can do to hedge against such a risk.
Yeah, I mean, what I wrote about in the little book that I wrote about this deep risk, as well as my later books, is that really inflation is the one you should really, really worry about because that's the most likely, and it's the one you can do the most about. The others are less likely, and to one extent or another, there's a whole lot less you can do about them. So that's the one you should focus on. That's the one where the money is in terms of risk management is hedging against inflation.
I'd like to tap into your neurologist background now. Have you witnessed or observed any particular types of people and how their brains are wired? These types of people, how do they manage risk better than most other types of people?
This is a rather subversive thing that I like to talk about, which is that I've observed in my investing career, and especially among friends and acquaintances, that the most empathetic people are the worst investors. All right. And the reason for that is simple. The definition of empathy is feeling others' emotions. So if other people are greedy or fearful and you channel into that, that's going to hurt you in the financial world. Now, I mentioned the book, The Big Short, but The Big Short is also an excellent book, and it speaks to that, which is there were about half a dozen people that Michael Lewis wrote about, and they all had severe personality disorders, except one, and we'll get to him in a minute. They all had severe personality disorders, which is just a medical way of saying that they were jerks who didn't have a lot of empathy. And they were the ones who that enabled them to be contrarians. Now, the one person who banked very spectacularly didn't have a personality disorder, but he did have Asperger's syndrome. And that's Michael Berry, who did a year of neurology residency. And that, if you have Asperger's syndrome, that is also a real asset in investing because you're not channeling other people's emotions. So if you're an empathetic person, if you know that you're an empathetic person, that should be something that you should deal with very aggressively and perhaps have somebody else manage your money.
Well, that's interesting. The traits of a good trader, can they be developed with discipline and practice, or are these traits something you are born with?
Well, it's the old nurture versus nature thing. It's usually half and half. So there are people who are intrinsically, because of their genetic background, better able to trade and able to filter out other people's emotions and isolate the mathematical aspects of what they're doing and integrate the history. But certainly training is also very important. You can't be an Olympic gymnast no matter how intrinsically talented you are without a whole lot of practice as well. That's the same thing.
Managing your emotions during a down market. Again, how do we separate the pros versus the rookies? Are there personality traits that are significantly different?
Well, yeah, as I explained, the person who is unempathetic is the one who doesn't channel other people's fear. Now, there's a certain intellectual framework that you have to have as well in order to be a successful trader or a successful investor, for that matter, which is that you have to be able to separate out your risky assets and your riskless assets. You have to be able to maintain separate accounts so that if your risky assets go down the tubes, you have enough riskless assets that you can say, I can still buy groceries. Okay. I can still pay my rent. I can still pay my mortgage, and I'm not going to panic. What I like to say is there is a reason why Warren Buffett holds 20% of Berkshire's assets in treasury bills. And I think that's one of there are a lot of reasons, but I think that's the main reason, which is that if all of Berkshire's equity assets go down the tubes, Warren Buffett and his heirs are going to do just fine. By the way, it's no longer 20%. I think at last accounting, he had 277 billion in cash on less than a trillion in market value. So that's like 28% in cash right now.
The degree of empathy, does that play in a role of in how much risk one takes on the upside? So how greedy you are, how much leverage you take?
Yeah, certainly. If everybody around you is getting rich trading real estate or trading .com stocks or tech stocks, it's happened. It has happened with .com stocks in the 1990s. Sure, you're going to take more risk than you can handle. Now, we all know that one of the primary neuropsychological characteristics of human beings is that we're overconfident. So we're overconfident about our ability to pick stocks. We're overconfident about our ability to time the market. But the overconfidence that is the most dangerous is our overconfidence about our ability to handle risk when the ottoman hits the fan. We think that we're risk tolerant. We can look at it in a spreadsheet and convince ourselves we're going to buy when prices are low. But in the actual event, the world is so scary that we wind up not being able to do that. And that is where empathy comes in. Is empathy basically encourages you to take more risk when the sun is shining, and that turns around to bite you when the storm clouds gather.
Well, you wrote in your book, The Investor's Manifesto, that a 25-year-old who is actively saving for retirement should get down on his knees and pray for a decades-long brutal bear market so that he can accumulate stocks cheaply. Okay, well, that's assuming he doesn't lose all his money. What do you mean by this quote?
Well, what I mean by this quote is there's something called sequence of return risk, which is a much larger phenomenon. So we all know that someone who retires wants to see the good returns first and the bad returns last. All right. Whereas if so that person will do very well. The retiree who does the worst is the one who retires in the equivalent, let's say, of 1966, when you have 18 years or 20 years of poor stock returns, which depletes the portfolio before the bull market comes back in to save your bacon, because by the time the bull market finally arrives, all of your money is gone. Exactly the opposite is true for a young saver. The young saver wants the poor returns first, and the bad returns last. So, excuse me, the bad returns first and the good returns last. Sorry, so that they can acquire stocks at low prices, and then prices rise, and they get to sell their stocks off in retirement. And you can demonstrate this very easily with both mathematical simulations as well as just using historical market data. So the person who accumulated their portfolio from 1966 to 1986, and then went on to retire in 1990 or 1995, did spectacularly well. All right. Whereas the person who acquired their portfolio over the past decade probably isn't going to be doing that well, because they will have acquired their equities at very high prices.
We're assuming also that the equity markets will eventually recover and not, repeat Japan from the 90s, which saw 2 decades of stagnation, right?
Yeah, it's a bet on mean reversion, and certainly the poster child for mean reversion not recurring is Japan, which is one of the reasons why you diversify abroad. You want to avoid the risk of being a Japanese stock investor or a Japanese retiree starting in the year 1990.
Do you think bear markets can potentially put off a younger trader or investor from investing altogether, psychologically scar him or her and keep him away from investing?
Absolutely. And that's one of the most important things that a young investor should do, is to truly ascertain their risk tolerance. And what I tell young investors is, yes, theoretically, you should invest 100%, heck, 200% in stocks. But I counsel young investors who've never encountered a bear market to keep about a 50-50 portfolio. And when that first bear market hits, see how they respond. Okay. If they buy more stocks, they've got the moxie to do that, then God bless. They should have a higher overall stock allocation for the rest of their life. But on the other hand, if they panic and sell, maybe they should be 25-75.
I think we saw that in the crypto markets in 2021, there was a huge bull market. Subsequently, the markets collapsed. A lot of people got wiped out. Now, Bitcoin's reached a new all-time high, but as I've observed with a lot of other people in the space, there's a lot less retail interest today than a couple of years ago in the last bull market. I think people were just put off by the market by the fact that they lost a lot of money. And so we're seeing that in real time. People are just put off and not going back in. What would you say to a younger investor who may be experiencing losses?
Well, you have to ascertain which person you are. Are you the person who realizes that the groceries have just gotten cheaper and you should load up on them, or are you the kind of person who can't handle seeing the value of the portfolio decrease? And you have to figure out which of those people you are and structure your risk portfolio, the amount of risk you take, accordingly.
Now, you've written about the causes and I guess, the drivers of economic growth in the book, The Birth of Plenty, How the Prosperity of the Modern World Was Created. Just sum it up for us. In your research, the main drivers and the factors behind a nation becoming prosperous, what are they?
Well, there's four of them. I wrote the book 25 years ago, so let's see if we can remember all of them. First of all, is rule of law and strong institutions and property rights. Okay. Second is scientific rationalism, having a scientific way of looking at the world. The third is capital markets, okay, having efficient capital markets so that projects can get funded and investments can get funded. And then the fourth is an efficient transportation system and communication system. Now, the last three are really of only historical importance because in today's modern world, every country in the world has access to capital markets, they have access to transportation and communication, and they have access to scientific rationalism. Even if they don't have a great university system in the country that you're in question, they can always send their kids abroad to get an education. What cleaves the rich from the poor nations of the world today is rule of law, okay, and property rights. And all you have to do to see a spectacular example of that is to look at a night satellite photograph of the Korean Peninsula. Okay, the south part of we've all seen this famous photograph, which is the South Korea is lit up like a Christmas tree, and there's only one little spot of light in North Korea, in Pyongyang, which I like to joke is Kim Jong Un's flat screen TV, and so that's what separates the rich from the poor today, and it's really that simple. It's how good are your property rights and your rule of law. Now the problem with that is largely culturally determined. Sort of the basic structure of rule of law in Northern Europe is English common law, and in the English speaking world as well. You look at the most prosperous countries and also the most successful stock markets in the world. They're in English-speaking nations: Canada, the U.S., New Zealand, the U.K., South Africa. And it's not Shakespeare. It's not that they're speaking the language of Shakespeare. It's they inherited the English common law, and English common law evolved simply from English folk culture. It's what people thought was fair and right. And what I like to say is that the paradigm I like to use to think about that is to imagine that you live in a given country and you are robbed in the presence of witnesses by a known assailant. Who do you go to for justice? In the richest countries in the world, you go to the police. Okay, in the poorest countries in the world, you go to your cousins.
Well, maybe if my cousins were really good lawyers, I would probably go to them in a rich country as well. But I understand your point. Okay, how would you explain China then? Is China an outlier, socialist by, I guess, decree, but has seen, the one of the, if not the biggest transformations of wealth over the last 50 years in modern history?
Yeah, again, it's a very good example of the importance of property rights. The average Chinese citizen went pre-Deng Xiaoping, pre-1978, to having zero property rights or almost no property rights. And now they've got pretty good property rights. I mean, maybe if you talk to Jack Ma, he might disagree. But in general, the average Chinese citizen doesn't worry too much about having their wealth stolen from them by the government. So you went from a regime of no property rights to pretty decent but not perfect property rights, and of course their economy grew like topsy. Now, what's really interesting to me from a political science and a political economy point of view is that one would predict that China would have become a much more democratic country because as people become richer, they are more demanding of civil liberties and autonomy. And one would have predicted 15, 20 years ago that China would had a good chance of evolving into a democratic system. That appears not to be happening, which basically goes against the prediction, I think, of most political scientists that they would have made. Why hasn't China become a more democratic country, even though it's become so much richer? So it's an interesting question.
You've also explored a pivotal point in history in which wealth started accumulating at a much faster pace than before, exponentially faster. What point was that?
Well, the traditional date that clinometricians like to identify is 1820. That appears to be about where the inflection point was. Before that, there was almost no growth on a per capita GDP basis from year to year. Maybe very slow growth in Holland and in England for about 200 years before that, and then all of a sudden in 1820, things explode. Why was that? Well, it was obviously transport and communications. Suddenly, you could get grain from the New World to the Old World. You had these incredibly impressive communications technologies. You had the introduction of the telegraph in the 1840s, the railroad in the 1820s. And that was the final of the four factors. That's why I talked about the four factors in the birth of plenty. That was the final piece of the puzzle in England in 1820 was the introduction of the railroad and the telegraph.
Are there deeper sociological or socioeconomic reasons as to why Europe saw the Industrial Revolution before other parts of the world?
That's a fraught subject, but they were the ones who embraced scientific rationalism. They were the ones who had the first well-developed capital markets, starting with the Italian and Dutch markets 500 years ago, 400 years ago. So that's where all four of those came together. It was the one place in the world where all four were present, and that ignition date was about 1820. It took the rest of the world a lot longer to catch up on those four factors.
Some people have said, and this is again hotly debated, that AI presently is the most revolutionary innovation since the Industrial Revolution, and perhaps we're seeing a new Industrial Revolution. Would you go as far as to agree with this statement?
No, it sounds like an awful lot about like the internet hype that we had 25 years ago. Robert Solow made a very famous joke about the computerization of American business and American society. Was that it was the computerization was and the technological advance was obvious everywhere but in the data. And I think we're seeing the same thing with AI. A year or two ago, about 5% of corporations were using it. Today, about 5% of corporations are using it in a big way. And we're certainly not seeing an acceleration of economic growth in the world as well. So color me skeptical.
Has the pace of innovation and the pace in which our living standards increased, has that pace tapered over the last couple of decades? In other words, the rate of change of our wealth and our living standards, has that deteriorated?
It appears that per capita GDP growth in the developed world is slowing down. It used to be about 2% per year in the developed world. It was almost like you could almost set your watch by it if you draw a semi-log graph of per capita GDP over the decades. But it appears to have slowed down. So the question is, why that? Why has that happened? And there's two theories about it. One is Robert Gordon's theory, which is that the pace of technological advance has significantly decreased, and that's an argument. That's a a, a subject that we could argue about for the rest of the day. I tend to think that's not the case. I follow the scientific literature as someone who's got physical science training. I read Nature, I read Science, and I see just a flood tide of technological advance when I look at those pages. The other explanation is the Borio-Chancellor explanation, which is that low interest rates have decreased the hurdle rate, and so there's a lot of inefficient investing getting done, especially in real estate, which is a totally non-productive economic sector. And so I think that's probably the reason, but I'm willing to admit that I could be wrong about that and that Robert Gordon could be right, or that there's a third explanation that we don't know, or that this is just a temporary blip and that economic growth will continue to speed up back up in the developed world to 2% per year in per capita GDP growth in the world's richest countries. I don't know which of those four cases is going to turn out to be the case.
Yes, and what needs to be done to accelerate the rate of change and growth of prosperity?
Well, it's basically a function of technological advance. All right. When you look at what has improved the quality of life and wealth, it's obviously technology. It's the ability, the amount of work, the amount of productive work that a given worker can do in an hour. It's just about economic productivity, and productivity is driven by technological change. Now, what's interesting is there's a phenomenon. It's called Baumol's law, which is that the things that are the most mechanized and are most subject to technology are the ones where you see the highest growth, and that you see the least productivity growth in fields that don't see a lot of technological advance. So, for example, in teaching, the cost of education increases because the price of everything else has fallen.
That's very interesting. And do you see another nation surpassing the U.S. in technological growth and ultimately economic growth?
Because if you're a bright young person with a good idea, you want to come to the United States. You might have a pretty good shake at doing it in Sweden or in France. But if I'm a bright young person with a brilliant idea, I want to come to the United States.
Because of the money or for some other reason?
No, because of the rewards. You're most likely to get rewarded in the United States, and the infrastructure, the scientific infrastructure in the United States is so fantastic. Now, it's also very good in China, but for God's sakes, who wants to live in China?
Yeah. Well, I guess the Chinese scientists have decided to stay there. So you don't buy into the I guess the theory where the prognostic that the forecast that China could eventually become the world's most dominant economy.
It's entirely possible. To have they've got this enormous population. Now that's another thing. I mean, the population of China is what, about four times that of the United States. So it only has to have a per capita GDP of one quarter of the United States, which it's nudging fairly closely. So they could overtake us in that regard. But I'm very worried about the political stability in China, and and of course it's also a quality of life issue as well. If you're a bright young person from Africa or Europe or Southeast Asia, you'd much rather move to the United States.
Over the last couple of 100 years, the population has seen boom after boom. Now we're starting to see a peak in fertility rates. In fact, in most developed countries, the fertility rates are going down. And so what we're seeing is now the global population shrinking potentially over the next decades, if not next couple of centuries, if this doesn't turn around, right? How is this going to impact economic growth?
It probably won't be good for economic growth for the simple reason that young people are the ones who innovate and old people are the ones who don't. The cost of the social welfare systems that are needed to support an elderly population are going to sap our capital structure as well. It's one of the things that is the major thing, in fact, that's driving the increase in debt around the developed world. And on top of that, there are real implications for political stability. It is forecast that by the beginning of the 23rd century, the Chinese population may fall from 1.4 billion to half a billion. We're already seeing that happening in Japan and in South Korea. I believe that the fertility rate is 0.8. That's not something that's sustainable for very long.
Discuss that another time. That's a topic for a separate conversation. I want to end on technology. Since you brought up technology, what this has nothing to do with economics. I just want to get your opinion on Elon Musk's Neuralink, implanting chips in our brain to interface with objects, through seemingly Wi-Fi, I guess, and potentially enhancing our cognitive abilities down the line. What do you think of this?
You're assuming that because I'm a neurologist, I'm able to forecast this, and I think
I'm assuming you know more than the average person, which I think is a fair assumption.
I do, and I think it's a very, very promising field. The problem, of course, is that the technology that Musk is exploiting is extremely invasive. Believe me, you don't want electrodes implanted in your brain unless you absolutely have to. Unless you're paralyzed and you can't move, and it gives you a chance of getting some muscular function, some motor function back. The real challenge is getting that from surface electrical brain activity, and that's a much harder row to hoe because you can only record from the top millimeter or so of the cerebral cortex, and just the computational problems of decoding that into usable cognitive output they're very, very high. I think eventually we're going to get there, and we may get there sooner than we think. So yes, I think it's an extremely promising field.
Well, the idea of downloading information or even uploading information wirelessly with a brain implant, is that science fiction or is that possible?
Oh, I think it's very real. I mean, you could already get reasonable cognitive output even from surface recording. For example, there's perhaps 15 or 20% of people who appear to be in a vegetative state actually can respond cognitively to external inputs. They can perform simple tasks if your recording technique and your number crunching are sophisticated enough. That's just been very recently demonstrated. So yeah, I think it's a very real possibility. I think it's an evolving field. All technologies can be a force for good or evil. God only knows. Once again, you don't want that technology in the hands of an authoritarian government.
Well, yes, that is a good point. Practical applications of this that you see could be commercialized.
I think so. Yeah.
What are these applications, do you think?
Well, I think that you could ask the same question: what are we going to be using the internet for? Had you asked that question 30 years ago, you wouldn't have come up with even 5% of the things that we're doing now. And I wouldn't want to predict what the downstream outflow of that is going to be, but it could be very significant. I wouldn't even want to predict specific instances.
Thank you. Well, that was a great talk. Thank you very much, Dr. Bernstein. Where can we read your work and follow you? I mentioned a few books already. I'll put them on the screen and in the description below. We've talked about the books, but where else?
Well, I write books, and of course, the most recent book, serious book that I wrote, was one called "The Delusions of Crowds," which is about mass manias, in both the financial and the religious field. The other you brought up the birth of plenty. The other book, and probably my best-selling history book, is "A Splendid Exchange," which is a history of world trade, which is very relevant to what's going on today. Currently, the place that I'm writing is for a website called advisorperspectives.com. And I do financial pieces for them. And I also am doing a lot of book reviews of historical and sociological books. I wrote, for example, a recent review of the Jonathan Haidt book, The Anxious Generation, which I think a lot of people found interesting.
Very good, Dr. Bernstein. Appreciate your time today. We'll speak again soon.
Okay, you take it easy.
Thank you for watching. Don't forget to like and subscribe.